Welcome back. Today I'm explaining borrowing cost, which is IS 23. What is borrowing cost? Borrowing cost is interest incurred / finance cost and other costs that an entity incurs in connection with the borrowing funds. So what they're saying is that if, for an example, I want to build a lecture hall at TUT and I go to the bank, I borrow money, the interest that the bank is going to charge me is borrowing cost. So they are saying any other cost, meaning like if you go to the bank, before you do anything, banks have got this thing called an initiation fee. So the initiation fee plus the interest that you're being charged in a loan that the bank has given you, it is called borrowing cost. Now, all along, we've known that interest is an expense. It goes to the income statement, right? So you'll expense interest on a normal, basically, cost of business and how we've been taught all along. But IS 23 gives you an alternative. IS 23 says you can capitalize. What is capitalization? What does it mean? It means you take the interest out of the income statement, you put it in the balance sheet with an asset. So in short, what these people are saying, they are saying, if, let's say you are building a lecture hall, you go and borrow 1 million at the bank, and the bank charge you 10%. So 10% of 1 million is 100,000. That is the interest that you are going to be charged by the bank. So, but the interest of 100,000 will sit in the income statement. But IS 23 says you can take it out, meaning remove the interest of the income statement and put it as part of the cost of the asset, meaning the asset or the lecture hall will become 1 million, the amount that you've spent, plus the 100,000, making it 1.1 million in the balance sheet. So interest capitalization means that you are moving interest out of the income statement, you put it in the balance sheet as part of the asset. Okay. I will show you as we do exercises what does it basically entails. Okay. Now here they're saying borrowing cost may include, right, interest expense or finance cost, like I said, from leases and financial instruments, transaction initiation fees, exchange differences on foreign loans, dividends on redeemable preference shares. Redeemable preference shares are treated as liabilities. All right. Now here they're saying borrowing cost excludes the cost of raising share capital. Share capital, remember, it is equity. And for an example, dividends on ordinary share capital, dividends on non-redeemable preference share capital. Right. Then they also include cost of using internal funds like retained earnings. Retained earnings is not liability, it's equity. So you cannot include that in borrowing cost because that is internal funds. Right. Here we are talking about the recognition and capitalization. Like I've explained what is capitalization. It says here, right, if borrowing costs are incurred as a direct result of acquiring, constructing, or producing an asset, that meets the definition of a qualifying asset. These costs must be capitalized. Right. It's either you acquire, or you construct, or you producing. More or less, construction and producing, you can interchange the usage of those words. And it meets the definition of a qualifying asset. A qualifying asset is an asset, you can see here, is an asset that requires a longer time to get ready for its intended use. You see, like building a house. A house, you can put it as a qualifying asset because it requires a longer time to build it. Okay. Now, in other words, borrowing costs must be capitalized to the cost of an asset if they are directly attributable to the acquisition, meaning there must be a direct link. In short, they are saying if you didn't borrow money, let's say you want to build a lecture hall, you borrow 1 million. Obviously, if they charge you 10%, the interest, the 100,000. If you didn't borrow the 1 million because you want to build a lecture hall, you are not going to incur the 100,000 interest. So that is directly attributable, you see. By virtue of you wanting to build the lecture hall, you have borrowed money, and that money came with the cost of interest of 100,000. So it's directly attributable to the acquisition, construction, and production of the lecture hall. Right. Now, here they are saying these costs must be capitalized if they meet the recognition criteria, meaning an inflow of economic benefits are probable, and the cost must be reliably measured. So when they talk about the probability of inflow, if you build a lecture hall at TET, the lecture hall will be used by students who are going to pay money to TET. So there is money, inflow of future benefits. There's money that TET is going to get. More students using the lecture halls. And we know how much. We've spent the 1 million to build the lecture hall. The cost must be measured reliably. We've spent 1 million building the lecture hall. We were charged 100,000 interest, so we can measure all the costs that relates to the lecture hall itself. Right. Now, as I've explained, a qualifying asset, that it's an asset that requires a longer time to get ready for its intended use or sale. Now, here, they don't tell you this issue of longer time. But in accounting, most of the times, a shorter period is less than a year. Anything above a year is long. But the statement doesn't give you a direction or a criteria in terms of how you measure this longer time. But that's what it says. But then it says this includes several assets such as plant and machinery, property, investment property, intangible assets, and inventories. Right. But excludes, these are not included, financial assets like investment in shares, inventories that take shorter time to manufacture, and assets that are ready for the intended use or sale on acquisition. Meaning, if you are selling shoes, you are someone who sells shoes. If you buy shoes now, you can sell them immediately. So they are ready for the intended use or sale on acquisition. Now, if you then look at what we always know, how to deal with interest. We always know that interest or borrowing costs are expensed. But IS 23 gives us an alternative to say you can capitalize them. You can capitalize the interest, remove it from the income statement, put it in the balance sheet as part of the asset. Right. If borrowing costs do not meet the conditions for capitalization, they are expense. They will form part of the expenses in the profit or loss statement for that period in which they are incurred. So we know all along that's what we've been doing. If they don't meet the criteria of capitalization, we expense them. Okay. Then here, they are saying the recognition or as an asset. Borrowing costs are recognized as part of the cost of an asset, like I've been saying, that once you remove the interest of the income statement, when you put it in the balance sheet, they become part of the cost of the asset. Like the example I've been making, that if you borrow 1 million and they charge you 100,000, meaning 10% interest, which is 100,000, the cost in the balance, in the balance sheet, it will be 1 million that you've spent, the cost plus the 100,000. So we've got an asset sitting in the balance sheet as 1.1 million. The interest is zero in the income statement because you've moved it to the balance sheet. But you don't move everything. You don't move the whole amount. There is a way in terms of which you calculate this thing. I'm going to show you. Okay. Right. Borrowing costs are recognized as part of cost of an asset, during what time can be called capitalization period. So meaning that time when you are doing this thing, that time when you're capitalizing, when you keep moving the interest off the income statement to the balance sheet, that period is called a capitalization period. The capitalization period has a start and an end, and may be broken for a period somewhere between these dates. So what they are saying is that there are three criteria that you must meet. You start capitalization, and it has got an end, meaning if I'm constructing a house, one way or the other, the house will be complete. When the house is complete, I stop capitalizing, right? And then they're saying somehow it may be broken for a period somewhere between these dates. So what they're simply saying, they're saying sometimes, let's say for example, when you're building a house, you'll start with the foundation. In terms of the foundation, once you put the concrete, you need to stop. Some they stop for a day or two, and they wait for that basically slab to be solid. So that broken period, it's sometimes necessary. It's part of the process. It's just like manufacturers of wine. Wine, there's something called wine fermentation, where they will tell you that this one must be in this big bowl for maybe 2 weeks. It's part of the process. So if something happens like that, is necessary, you don't stop capitalization, meaning the capitalization period continues. Like when you're waiting for the foundation to be solid, like when you're waiting for wine to be well fermented, you don't stop capitalization, you continue. It's necessary, it's part of the process. But in some instances, you'll find that, for an example, people are building your house and then they go on strike due to something. That one is not necessary. It's not part of the process. And therefore, it's what we call a broken period. Like here, they are saying it may be broken for a period. That stops capitalization. If something like that, let's say people now decide they go on strike, or you are building RDP houses, and you've decided to adopt capitalization, and your builders and whatever, they go on strike, it's not part of the process, so they're breaking the period of capitalization. So you stop capitalization when that happens, and then you start once they go back to work. But if something is necessary, like waiting for the foundation to be solid, you don't stop. Waiting for wine fermentation process to be complete, you do not stop. Okay, right. When do you start capitalization? When do you commence? You start capitalization if the basic recognition criteria are met, and an entity must start to capitalize borrowing costs from that date, and that all of the following are met. Okay. Now, here are these 3 criteria. They are very tricky. People must always understand, when do you start? Now, I've made sure that I make all to be bold. From the date that all the following criteria are met. They are saying, what are these 3? Borrowing costs are being incurred. Right. Borrowing costs must be incurred. Expenditure is being incurred by the entity in preparing the asset. So we must incur borrowing cost. The expenditures must be incurred. The activity are underway to prepare the asset. Now, let me give you an example. If on the first, meaning borrowing costs are incurred, on the second, expenditures, you start to incur them. Third, your activities are underway, you start your activities. Your borrowing cost capitalization process, or the capitalization period, will start on this date, the third one, date number 3, this. Because that's when all of them are there. You can't start here. Let's say it's date number 1 or day number 1. You can't start in day number 1 because number 2 and 3, they're not there. They're not there yet, meaning incurring of expenses and the activities have not started, the 2. This thing says all must be there. So if day 1, you incurring borrowing cost, you can't start capitalization because you have not met date 2 and 3. By date 2, you still cannot start because you only have 1 and 2. Number 3 is not there. Date number 3 has not basically occurred. Once you've got number 3, once you're in date 3, then you know, oh, day 1 I started having incurring borrowing costs. Day 2 expenditures were there. Day 3 the activities are there. No, now all the 3 in day number 3 they are there. Okay. So you start capitalizing in day 3. So be careful that all of them must be there. When you check the dates of when you must start capitalizing, they must all be there. Right. When do you suspend? Right. When active development of a qualifying asset is suspended, the capitalization of borrowing costs is temporarily suspended. The suspension of capitalization occurs if the delay, one, the delay is for a longer period and is not necessary, right, in getting the asset ready for its intended use. Meaning, like the example I gave you of a strike. Strike is not part of construction. It's not part of the construction process, right? And is not for a substantial, sorry, technical and administrative work, right? So here they're talking about these complicated buildings where they will tell you after constructing phase one, you must wait because engineers want to do 1, 2, 3 before you continue to stage 2 and all that. So it is that delay, if it's not part of that, so it's not necessary. And then it does not basically warrant a non-suspension. So you have to suspend if it's not necessary. It says do not suspend if the delay is short or if it is long but yet necessary. So once it's necessary or it's part of the process, you don't do a suspension. Okay. When do you cease? When the asset is ready for its intended use or sale, or is substantially ready, meaning once it's complete or it's ready for its intended use, or you can then cease. Right. Right. Measurement. These are the most critical ones. You have to at least understand what is happening, because now we are measuring this borrowing cost. We are measuring this amount that you must capitalize, meaning the amount that you must move out of the income statement to the balance sheet. There are two types of borrowings, which is specific borrowings and general borrowings. All right. Specific, you are talking about an instance whereby I go to the bank, I borrow a loan amount of 1 million. I want to build a lecture hall that will cost me 1 million. I specifically went to the bank and borrowed that money to specifically build. General borrowings, we are talking about something like bank overdraft. If I've got a bank overdraft, the bank overdraft I will use to build, but then the bank will start deducting things from it, like your interest on overdraft. A lot of things will happen with the bank overdraft. Even some companies, they borrow more money so that at least they can be able to pay even their salaries using that bank overdraft. So that is a general, because it can be used not only specifically for that project, but for also other things. Okay. Now, I'm going to start with specific borrowings. In order to calculate the borrowing cost to be capitalized, or the interest to be capitalized, you need to understand there's a formula that you must know or use, right? This formula says you start with borrowing cost actually incurred during the capitalization or construction process. Now, this thing is specific. Be careful, because it doesn't say take the whole amount of borrowing cost. It says only the amount that falls under this period, right? So in short, they are saying once these criteria are met, that is your starting point for that construction period. And that process will end here. It will end there. So this period is the period when the three criteria are met. It starts there. It stops at the session of capitalization. And then it says less, let me highlight this, investment income. Now, what does it mean? It means, for an example, if I borrow 1 million to build a lecture hall, most likely I'm not going to use first day. I'm not going to use the whole amount. On the first day, I'm not going to use the whole amount of borrowing cost. I'm not going to say 1 million, boom, the whole amount. You'll find that maybe I'll buy for 100,000, there's still 900,000 left. I buy the following day for 50, there's still more money left. So investment income comes into play that if I spend 100,000 in the first day, I'm left with 900,000. That money, I can invest the 900,000. It sits maybe somewhere in the bank, and I will be earning interest. I'll earn interest with that amount. So they're saying the borrowing cost that you're incurring, you must less investment income and on the temporary investment of surplus funds. Surplus funds is that 900,000. If I spend 100,000 from the million, I'm left with 900. So I invest the 900. It's what we call surplus borrowings. Surplus borrowings, it's that amount that you are not using at that time. You invest it. So they're saying the borrowing cost, these ones, then you minus the amount that you are earning because you've invested surplus funds, it will then give you interest to be capitalized. Okay, right. And interest to be capitalized, that is the amount you are moving out of the income statement to the balance sheet. Now, let's then look at an example that deals with borrowing cost under specific, right? Now, it says here, specific borrowings when expenses are evenly incurred. Evenly incurred means they are spread across the expenses. You can see here, you're incurring expenses. They say from January 1 to 31 March, 1.6. So January, February, March, for 3 months, you've spent 1.6 million in the first segment here. Right, you've spent 1.6 million in the first segment here. Now, they are saying to you, they don't tell you that on the 15th of January you incurred 1.6. No, they're saying for that 3 months, you've spent about 1.6 million because you'll find that day one, maybe 1 January, you spend 10,000, second, 8, third, 5, on and on until you reach 31 March. And in total, you've spent 1.6 over 3 months. So if expenses are incurred in that fashion, where they are spread over 3 months, 2 months, over a certain period, or over even a month, and it's more like they're not giving a specific date, those expenses are evenly incurred. Evenly means they are spread across a period, right? So every time, the first thing you do here, you'll say, okay, what is happening here? You'll say, okay, this company is building a stadium. The stadium will cost so much. The stadium will be completed here. Right. These are the expenses. When you look at these expenses here, you can see that 1.6 is over 3 months, 1.2 over 3 months, 1.4 over 3 months, 1.7 over 3 months. So they are spread across 3 months, 3 months, 3 months. Those amounts are incurred over a 3-month period, right? So then you will then say, okay, now, when do I start capitalizing? Now, you start checking the 3 criteria. These criteria, you start checking them. Where there's 3 criteria, here. You start checking this. When is borrowing cost incurred, when expenditure is incurred, when activities are underway. Right. Now, let's analyze the question. Started with the construction 1 January. So activity has started 1 January. I've got activity by 1 January. On 1 January 2010, obtain a specific loan for 10,000. So 10 million, sorry. The interest rate is 10%. The general loan will be repaid the following. Now, this statement tells you that you are incurring interest now, or the borrowing cost. You are incurring them, right? So I've got the activity starting 1 January. I've got the borrowing cost starting also 1 January. So I'm missing one, right? I've got the activity. I've got the borrowing cost. Now, what else is left? The expenses. I come here. So from 1 January, I started incurring until here in terms of this segment. So I can safely say from 1 January, we started incurring expenses. So the 3 criteria were all met by 1 January. 1 January, 1 January, 1 January. Expenses 1 January. Activity 1 January. The borrowing cost 1 January. So the three criteria that we have to check were all met by 1 January. Okay, they were all met on that date of 1 January. Now, so we know we must start capitalization 1 January. So we know we've got a specific loan of 10 million. So we know we're dealing with a specific borrowing. The next thing now you'll say, okay, how much is my interest from, or my borrowing cost from 1 January? I'm fitting this thing in this formula now. I'm calculating this part there. Borrowing costs actually incurred during the capitalization/construction process, the one I've highlighted. So I will then say, okay, how much have I incurred? It's 10 million at 10%. And the general loan will be repaid the following. So this thing has not been completed. You see, the completion date is estimated to be that date. So by end of 2010, I have not completed this thing. So I can then safely say, okay, you've got these requirements that we are going to deal with them here. Right, you've got the requirements. Then we look at the calculation. The first step, 10 million at loan for 12 months. That gives me 1 million. Right, 1 million. Now, I've calculated number one. Be careful. If this thing, let's say for an example, was completed in 2010 October, this was going to be 10. If it was October, you are complete, done with the asset. You're going to say that amount was going to be 10 there, because you'll say January to October. I have to stop in October, so it's 10 months. It's not the whole year. So that's what you are going to do here. Even below, when you are dealing with investment, you're going to stop that at 10 months again. Now, let's then look at this thing. The formula says once you've calculated the borrowing cost, you must now less this less asset average surplus borrowings. So I'm talking about the investment income here. The investment income, which I've already alluded to here. So we're calculating this one, the investment income. Right. Now, the rule says if your expenses are evenly incurred, like here, when you calculate the investment income, you must use the average surplus borrowings. Right. Let's think about this. Excuse me, I'm coming down with flu, but I'm trying to control that part. Now, let's think about it. What do they mean? For an example, I'm going to give you this part here so that you understand what is it that they're talking about here. Average surplus borrowings balances. If I've got 10 million and I'm looking at this period here, it is safe to say 1 January 2010, I'll start having 10 millions. I'll be having 10 millions. So as I'm saying 10 millions, it's 10 million. 10 million. And if I spend the 1.6, by end of March, 31 March, from the 10 million, I would have spent 1.6. Right. I will be having, let me see, 8.4 million. By end of March, I'll have 8.4 million because 10 million minus the 1.6 tells me by end of March, I will be having 8.4 because I would have spent 1.6 from the 10 million. So my average surplus funds, meaning the money that I'm not using, my average means something, you take two figures, you add them together, you divide by 2. Now, let me then demonstrate this in terms of the calculation. This thing says if I'm looking at the period from January to March, I'm going to start, when I start from 1 January, I'll have 10 million. From the 10 million, I'm going to spend 1.6. I'll be left with 8.4 by end of March. So average is this plus that. I'll start with 10 million. I'll end up with 8.4 in that period. Average, you see, that is why I'm dividing by 2. Because anything that is average, you are dividing by the number of figures there. Okay. So in the question itself, they are saying surplus funds are invested at 5% per annum. Meaning your investment, you get 5%. So you'll multiply that by 5% for 3 months. Remember, it's 3 months because from January to March, it's 3 months. Okay. You'll start the next period with 8.4. When I start the next segment, I'll have 8.4. And I will then incur, from the 8.4 that I'm left with, I will incur 1.2. 8.4 million minus 1.2, that gives me 7.2, you'll see here. Divided by 2 times 5% times 3 over 12. When I start the next segment, I will start it with 7.2, and I will incur 1.4. And if I incur 1.4, I'll be left with 5.8 by end of that period. I average times 3 over 12, then the number of months. I start the next segment with 5.8. I incur 1.7, and then I'm left with 4.1. You see. Now, from the borrowing cost of 1 million, I have earned an investment income of 355,625. The difference between the two gives me 644,375, which is my interest to be capitalized. That is the amount I'm going to move from the income statement to the balance sheet. Now, so you've calculated number 1. Now, what you then need to do now is to give us these notes here that they're asking for: finance charges and property, plant and equipment, and they also need the journal entries, right? There's a a sentence here which is very important. It changes the solution, right? This one here, it changes the solution. Interest capitalization is capitalized / compounded annually. So I'll show you what it means when I'm doing the next exercises. It can change the solution. If I change, for an example, annually to quarterly, it changes this calculation. It changes this calculation here, right? It can change that calculation, for an example. But I will show you how do you deal with that sentence, which is this one here. For now, it says it's annually, meaning you add interest at the end of the year. In other exercises, it can say monthly, quarterly, half yearly, but I'll show you how you deal with that, okay? Now, let's do the finance charge note. Here's your interest. But now, be careful about this interest, right? This is the actual interest, not this interest that comes here. Exactly. It's not this one. You know, let me show you what I'm saying. If, for an example, you have 10 million, you borrow 10 million 1 January, and you complete the project by October. Here you won't have 1 million. You'll have, for an example, it will say 10 here. And then if it say 10 here, it changes this amount. It will change this amount. But if that 10 million you have not paid by end of the year, in this one here, you'll still put here you'll put 1 million, because from January to December you have not paid the 10 million. That is the total finance charges there. So in short, let me see if I can do this thing the way. Let me show you by an example so that you don't get lost. So here, if this thing is completed by October, this will be the figure here. Because the formula says everything that you do here must be under the construction period. And you must remember, if that is the case, some of these things will change here. I think this one maybe might fall out. You only need 1 month here. This one must be 2, I think, to get it right. Yeah, 3, 6, 9. No, it can be 2, should be 1. See, 3, 6, 9. Yeah, 10. You see, 10 to 10. It should look like that. And then automatically it will change the 61. It will change this figure here. Okay, if I do that. Now, when I come here, it will still be 1 million because you've borrowed money 1 January. By end of December, you have not paid it. Right, it still be 1 million. Now, I want you to see the difference between this interest that you're putting here and the one that is here. They are not usually the same. In this exercise, we've kept it more or less the same. So, in short, I'm saying the one at the top, this one, is dictated by the capitalization period. If I'm starting something 1 January, I complete it in October, it's 10 months. But if I have not paid that loan by end of the year, meaning by December, my interest in the income statement is 1 million. Right. But the formula gets dictated by the construction period. So you must always be careful in terms of what you are then doing. Right. Okay. Total finance charges is 1 million. You must capitalize, meaning you must move this one from out of the income statement. You see it says minus. You are moving it out. It reduces the finance charges to 355. And then you take it to the balance sheet. It forms part of the cost of an asset. You'll see here's the amount now. The one that you are removing from income statement, it is now sitting in the balance sheet. Okay. Now, the cost of this asset, you'll see here is 5.9. What is 5.9? All the costs that you've incurred are these amounts here. These amounts here. When you're building a house, you spend 1.6 million, 1.2, 1.4, 1.7. When we ask you, how much did it cost you? You'll say, I've spent 5.9. So 5.9. Plus the interest that you've capitalized. By end of that period, your asset is at 6,544,375. All right. So you've answered required 2 here. Now, if you go to required 3, it says prepare journal entries. When I'm preparing journal entries, I would say debit bank, because when I get this 10 million, I'll put it in the bank and I will raise a loan that is payable a liability. And I will capitalize 5.9 to the asset that I'm building and pay out of the bank. And this is the interest that I must pay on the loan that I've borrowed of 10 million, the one in journal entry number 1. Then here I'm capitalizing the interest to be capitalized, meaning when you move the interest to here, this is the debit here, which is this one here. Right. And here you are crediting an expense, which is this one here. Right. Okay. Now we move on. Here we're saying specific when expenses are actually incurred. Now they give you an actual date. So, right. So you will see you still calculate borrowing cost under a construction period, but now you use actual surplus funds borrowing because the expenses are actually incurred. They give an actual date. Right. So the scenario is still more or less the same like before, except that now we've changed a few figures, like here it's 9, the loan is 9 million at 15%, the investment is 6, surplus funds are invested at 6%. It's still more or less the same, but I will show you the difference when you see the date here. They're giving you actual dates now. They're not saying for 3 months, they're telling you by 31 March you paid 1.6. 30 June, 1.2. So now, here is the calculation. You've got 9 million that you've borrowed, which is this one. at 15%. So the dates have not changed. Activity, your bet has been incurred. Right. Now I'm looking at this. Something tells me something was not done the right way. Let's check. Because now let me tell you why I'm saying I'm looking at this. You see this amount here. So the activity starts here. The loan is here, but you see the expense is here. So the capitalization period cannot be 12 months. It should be around January, February, March. For 3 months, we have not. We can't do capitalization for January, February, and March. We can't do it because the first expenditure was incurred by 31. So it tells me that 3 months we cannot put it there. I've got a feeling that our solution won't look right, but let's check. Okay. Let's check. Like I said, you see, it says 9 million at 15%. Né? But you see here, it's calculated over here. It says 12 months. It cannot be. This thing has to be 9. Because January, February, March, there was no expenditure. Remember what I said? I said the 3 criteria must be there, all of them at the same time. This one is there. The borrowing cost is incurred, the activity is incurred, but the expenditure is not there. It's here. So you can only start capitalization by 31 March because all the 3 they are present now. All. I've said that all the 3 must be there. It says that if you remember what I said here. If you remember what I said here, it says all the following are met. It doesn't say one, it says all of them must be met when you start capitalization. All the 3 must be met. So in that exercise, the expenditure is 31 March. So all of them are present at 31 March. Right. So, like I said, when I read this thing, I immediately saw that here, I think the solution might not be the way it's supposed to be. Now, but be that as it may, it's fine. Let's deal with this. It's 9 million. Let's calculate this thing. 9, 1, 2, 3. 9 million times 15%. Let me see. 9. I was pressing something wrong here. 9 million times 15% times 9 divided by 12. This figure becomes I'm very happy that this thing will demonstrate what I was saying now. Here, it becomes this figure. That's the right figure. That's what it should be. Okay. Then, investment income is, now you see this, it cannot form part of the calculation because from January to March, one criteria was not met. So this one must go, fall out. It goes, must fall out. Right. This is what you'll remain with. Okay. But we need to be careful in terms of what we are doing here. This calculation must change somewhere here. This one here. Let's check. So by March, 1.6 million was incurred. So by end of March, you are no longer left with 9 million. You were left with a lesser amount. Right. So when you start April, it was 9 million. When you start here, April, it was 9 million minus the 1.6, right, for those 3 months until end of June, here, until end of this one, you had incurred the 9 million minus 1.6, okay? So that was the amount that you've invested, right? Let's see. Right, which is fine. You've got the 9 million for 3 months. You've minus 1.6 that you've incurred by end of March, which is correct. This one is correct. You are left with 7.4 because 9 million minus 1.6, it gives you 7.4. And then you incur this 1.2 by end of June. So from 1 July, you are running with this amount, and it gives you 93. You open at 6.4, or 6.2, not 6.2, you incur 1.4, you run with it until end of December. Right, when you start the following year, whichever the balance was, then you minus the one in December, which is 1.7. Now, be careful, these dates, we can change them to 1 March, 1 June, 1 September, 1 December. It doesn't mean because I'm saying 31 here, we cannot change them to 1. We can say 1 March, 1 June, 1 September. It changes how you deal with this calculation here. Okay, right. Now, we have this. So I'm trying to add this. This figure becomes this one. So now here's what happens. Now this is how much you must capitalize. Okay, now here is this thing that I was saying. Do you see this is 1.3? It remains the same because it's for 12 months. Remember, if you read the question, 9 million is borrowed here for at 15%. This loan was not paid until 2012. So from January to December in 2010, the loan is there, unarguable. So here, the amount is this one. It's the loan from January to December. It has nothing to do, this 135 has nothing to do with the formula at the top in required one, where it says 10, 12, 500. This one, yes, it is more or less coming from the same calculation, but it has nothing to do with that one because this one is 9 months. It's the construction period or capitalization period is 9 months. It's from March to December. Okay. Now, but the loan itself is there. It exists in terms of accounting. It exists for 12 months, so we erase that. So here, we must capitalize right minus 736,500. Okay, that leaves us with 613. Okay, that's how now this one looks like. Okay, which then means if you have to capitalize, you're going to capitalize. Okay, that will then change. It is 663 6 500 636. This should look like this. Okay. Now that is how this whole thing will look like now. We've changed a bit of a few things, right? Happy to see something like this because every time I do something, I will realize that this doesn't look right. It's how it should be. This is how it should be. Now, general entries, the loan is 9 million. The expenses you are capitalizing is 5.9. The interest will remain like this. The one that we are capitalizing is 736,500. It's not right, this one. 736 500. Okay, that makes it correct now. Okay, all right. So that exercise, when dealing with actual dates, you deal with it in that fashion because the dates now are actual, and you are using actual surplus borrowings. Okay. Now your specific, it's either you incur expenses evenly or you incur them at an actual date. Okay. So you've got that situation here. We've dealt with this one here. Okay, here are the entries that relates to that. Okay, so that should be one of those instances where you are able to handle this situation. Thank you. I will then continue with general borrowings in due course.